Did you know that a person earning $25,000 a year can end up paying over $1,000 more per year than someone earning $100,000 for the exact same groceries, the exact same bills, the exact same life? Not because they're spending more, but because being broke is quite literally expensive. And if no one has ever explained the poor tax to you, there's a very real chance it's quietly draining hundreds, maybe thousands of dollars from you right now every single year, and you don't even know it's happening. In this video, I'm going to show you exactly how being poor makes you pay more, whether this is already happening to you right now, and why this might be the real reason you can't get ahead no matter how hard you work. Let's get into it. I want to tell you about a guy I know, Marcus. Marcus was working full-time, doing everything right, and every single day he was opening up Uber just to get to work. He didn't have a car, couldn't afford one, or at least that is what he thought. One day he actually sat down and added it all up: work rides, grocery runs, the occasional late night when he missed the last bus. He was spending around $650 a month on ride shares. Someone pointed out to him, "That's more than a car payment." He didn't believe it, so he looked up. The average used car payment runs around $500 to $550 a month. Marcus was already paying more than that every single month and had nothing to show for it. No car, no equity, just gone. And here's the thing, it wasn't that he was bad with money. The problem was he never had the lump sum to get started. No $2,000 or $3,000 for a down payment. So he kept paying piece by piece, ride by ride, and that method cost him significantly more. He was trapped not because he wasn't working hard enough, but because the system charges you more when you can't pay upfront. That is the poor tax. Having less money means paying more for the exact same life. And every dollar lost to extra costs is a dollar that never gets saved, never gets used to buy your way into something cheaper. Marcus didn't have a spending problem. He had a poor tax problem, the banking penalty. And it doesn't stop you at transportation. Let's talk about something you probably check every single day: your bank account. Wait, your bank account is actually costing you money. Yeah, this one hits different because it's so quiet. Nobody sends you a letter that says, "Congratulations, you're being charged extra for being broke." It just happens in small amounts regularly until you add it all up and feel sick about it. Here's how it works. Most traditional banks, we are talking about the big banks, the ones with branches on every corner, they offer free checking accounts, but free has conditions. You need to maintain a minimum balance, usually somewhere between $1,500 and $2,500 depending on the bank account. Drop below that threshold and they flip a switch. Suddenly you are being charged a monthly maintenance fee just to keep your account open. At Chase, that's $12 a month. Bank of America charges up to $12 as well. Well, Fargo sits in the same range. Sounds small, right? $12. But $12 a month is $144 a year. And that is just the maintenance fee. That is not even the worst part. Let's talk about overdraft fees. The average overdraft fee in the US is around $26 per transaction. One bill hits a day early. One automatic payment you forgot about. One moment where your timing is off by 24 hours, and that's $26 gone. Just like that. And people don't get hit with overdraft fees once. They get hit 2, 3, sometimes 4 times in a single month. That's over $100 in a month just in penalties, just for being tight on cash at the wrong moment. And here is where it gets really frustrating. Wealthy account holders don't pay any of this. Not a single dollar. They maintain the minimum balance without even thinking about it. So the free never triggers. They get the same account, the same bank, the same services, completely free. While someone living paycheck to paycheck is quietly getting charged every single month just for existing in that account. Same bank, same account type, completely different costs based entirely on how much money you already have. There are better options out there. Online banks and credit unions that don't charge these fees regardless of your balance. But the point right now is just to see it clearly, to recognize it for what it is. The poor tax isn't abstract. It's not a theory. It's a line item on your bank statement every single month, has been this whole time. Credit score trap. But here's where it gets wild. Because the poor tax does not just show up in fees. It shows up in the interest rate you're quietly being charged on everything you have ever financed. So your credit score is making everything more expensive. Yes, and most people have no idea how much more expensive. They think a credit score is just about getting approved or denied. Like it's velvet rope. You're either in or you're out. But that's not really how it works. Your credit score isn't just a yes or no. It's a pricing mechanism. It determines how much you pay for everything you finance. And the difference is not small. Let me show you the math. Take a $15,000 used for car loan. Pretty average purchase. If you have a credit score around 750, which is considered good, you might qualify for an interest rate around 5 to 6%. Over a 16-month loan, you would pay somewhere around $2,000 to $2,500 in total interest. That is the cost of borrowing that money. Now take the same exact car, same $15,000, same 60-month loan, but this time your credit score is around 580, which is considered poor. Now your interest rate jumps to somewhere between 15% and 20%. Suddenly you're paying $6,000 to $7,000 in total interest on that same car. You're paying thousands of dollars more for the identical vehicle just because of a 3-digit number. And it's not just car loans, it's personal loans, it's credit cards, it's every single thing you ever finance. The interest rate follows you everywhere, and the worse your score, the higher every rate on every product every single time. Now here is the part that really ties it back to everything we have been talking about. The less money you have, the harder it to build good credit. You're more likely to carry high balances because you need to. You're more likely to miss a payment without an unexpected expense hits. You're more likely to have a thin credit file because you have not had access to credit products in the first place. All of those things drag your score down, which raises your rates, which makes everything more expensive, which makes it harder to save, which makes it harder to build good credit. It's a loop and it's designed to be won. Your credit score was never just about approval. It was about how much you pay for everything. And the less money you start with, the more the whole system charges you to exist in it. The insurance premium gap. And here is something that made me genuinely angry when I first learned it. Your car insurance premium. It might have more to do with your credit score than your actual driving. My insurance costs more because of my credit score, not just my driving record. Yes, and I want you to really sit with it for a second. Because most people assume their insurance rate is based on how they drive. Your accident history, your tickets, your age maybe, and those things do matter. But in most states, insurance companies are also legally allowed to factor in your credit score when they calculate your premium, not your driving, your credit. In fact, a 2022 report from the Consumer Federation of America found that drivers with poor credit can pay anywhere from 50 to 100% more for the exact same auto insurance coverage than drivers with excellent credit. Same car, same driving record, same coverage, double the price, just because of the credit score. And it goes even deeper than that, because it's not just your individual credit score affecting your premium, it's also your zip code. Insurance companies use something called territorial rating, which means they look at the claims history and risk data for your entire neighborhood when setting your rate. And lower income zip codes, which tend to have older vehicles, higher uninsured driver rates, and more densely packed roads, get hit with higher base premiums across the board, even if you personally have never filed a claim in your life. So you're being penalized for where you can afford to live, not for anything you actually did. And look, insurance companies will tell you this is just actuarial math, risk assessment. But what it means in practice is that someone living in a lower income neighborhood with a lower credit score is paying significantly more every single month for the same protection as someone in a wealthier zip code with a higher score. The math works out for the insurance company. It does not work out for you. Here is the part that actually gives you some power though. Improving your credit score has a direct, measurable impact on your insurance premium. It's one of the fastest ways to lower a monthly bill that most people assume it's just fixed. You can't always change your zip code overnight, but you can start moving your credit score. And when that number goes up, your insurance bill comes down. It was never just bad luck. There's a system, and now you can see it. The rent versus own penalty. Now let's talk about the biggest monthly expense most people have and why renters are often paying more than homeowners for less. I'm paying more to rent than I would to own, but I can't afford to own. And I know that sounds backwards. It sounds like it can't possibly be true. But let's actually look at the numbers because you're pretty hard to argue with. According to data from National Association of Realtors and various housing market analyses, in dozens of major US cities, the average monthly rent for a 2-bedroom apartment is actually higher than the average monthly mortgage payment on a similarly sized home in the same area. Cities like Miami, Atlanta, Phoenix, Tampa. In some of these markets, renters are paying $200, $300, sometimes $500 more per month than someone who owns a comparable home nearby. So the monthly payment to rent is already higher in a lot of places, but that's actually not even the most painful part. The most painful part is what happens to that money after you hand it over. When you make a mortgage payment, a portion of every single payment builds equity. That means you're slowly buying an asset every single month. You own a little bit more of something that has a real value, something you can sell, something you can borrow against, something that can be passed down. Homeowners in the US have a median net worth of around $255,000. Renters have median net worth of around $6,300. That gap isn't coincidence. That gap is equity. When you make a rent payment, that money is gone completely. It goes to your landlord, who is building equity using your money. While you're building nothing, you are literally funding someone else's wealth while yours stays flat. And here's the trap. The reason most people can't make the jump from renting to owning isn't the monthly payment, it's the upfront cost, the down payment, the closing costs, the credit score requirement. You might be able to afford the mortgage every month, but you can't get past the front door because you don't have $15,000 or $20,000 sitting in a savings account. So you stay in the rental, paying more, building nothing, while the barrier to ownership just sits there, just out of reach. No matter how hard you work, the system isn't neutral. It rewards ownership and quietly penalizes renting, even when renting is the only option you have. The grocery and food desert problem. And it's not just about the big purchases. The poor tax follows you to the grocery store too. The neighborhood I can afford is literally making food more expensive for me. Yes, and this one is important because food isn't optional. You can decide to keep renting for now, but you cannot decide not to eat, which means this layer of the poor tax hits absolutely every day, no exceptions. Here is what's actually happening. Lower income neighborhoods across the US are statistically far more likely to be what's called a food desert. A food desert is an area where residents do not have reasonable access to a full grocery store, no Kroger, no Publix, no Walmart Supercenter with a full produce section. According to the USDA, about 19 million Americans live in food deserts right now, and the overlap between low-income zip codes and food deserts is not a coincidence. It's a pattern. So what do people in those neighborhoods do? They shop where they can. Corner stores, gas stations, small convenience stores, dollar stores, and those stores charge significantly more per unit for the same products you would find cheaper at a large grocery chain. A can of soap that costs $1.29 at a big grocery store might run you $2.49 at a corner store 2 blocks away. That gap adds up fast across an entire week of groceries. And then there's the bulk buying problem. One of the most well-known ways to lower your grocery bill is to buy in bulk. Bigger packages, lower cost per unit. Warehouse stores like Costco or Sam's Club are built entirely around this idea. But buying in bulk requires 3 things that a lot of lower income households do not have. Storage space, because you need somewhere to put it all. Transportation, because you need a car to haul it home. And cash flow, because you need to be able to spend $40 on one item upfront even if it saves you more over time. If you don't have all 3 of those things, bulk buying isn't an option. So you buy smaller quantities more frequently at higher per unit prices, and you spend more on food than someone with more resources, even if they're eating the exact same things. Where you can afford to live determines what you pay for food. The zip code is a tax, the time poverty multiplier. But here's the part that does not show up on any bill, and it might be the most expensive tax of all. Wait, my time is being taxed too? Yes, and this one is sneaky because it does not feel like a financial problem at first. It just feels like being tired. It feels like never having enough hours in the day. It feels like falling behind no matter how much you do. But there is actually a very real economic cost buried inside all of that exhaustion. Researchers at Harvard and Princeton have studied what they call scarcity mindset, the cognitive and time burden that comes specifically from managing financial stress. And what they found is that lower-income households spend a disproportionate amount of time just dealing with being broke, not spending money, not enjoying life, just managing the logistics of not having enough. Think about what that actually looks like in real life. You take 3 buses to get a grocery store in a better neighborhood because the one in your neighborhood charges more and has less selection. That's 2 hours round trip. You spend 45 minutes on hold with your utility company trying to negotiate a payment extension because you can't cover the full bill this month. You work a second job or a third just to cover the gap that the poor tax is already creating. You navigate complicated applications for assistance programs that requires documentation and follow-up appointments and reapplications every few months. All of that takes time, enormous amounts of time. And time is the one resource that is completely non-renewable. You cannot make more of it. And here is why this matters so much beyond just feeling exhausted. Every hour spent managing financial scarcity is an hour that cannot be spent on anything else. It cannot be spent learning a new skill that could increase your income. It cannot be spent building a side business. It cannot be spent researching investments or better financial products or ways to reduce the exact taxes we have been talking about this whole video. The poor tax does not just drain your wallet, it drains the mental and physical bandwidth you would need to escape it. Researchers actually have a term of this. They call it the bandwidth tax. The idea that poverty consumes so much cognitive energy just to survive day to day that there's genuinely less left over for long-term thinking and planning. So the reason you feel stuck isn't personal failing. It's not laziness. It's not lack of ambition. Your bandwidth is being taxed right alongside your wallet. And that is by far the hardest tax to see, which is exactly why we needed to name it, breaking the cycle one layer at a time. So now that you can see it, all of it, let me show you exactly where to start. This feels overwhelming. Where do I even begin? And I get that completely. We just walked through 6 different ways the system charges you extra for having less. But here's what's important to understand. The poor tax is layered, which means you don't fix all of it at once. You fix the cheapest layer first, and that first fix funds the next one. So let's walk through what that actually looks like. First move is the simplest and costs you nothing. Switch to a free checking account. Online banks like Ally or Chime or a local credit union will give you a full checking account with no minimum balance requirement and no monthly maintenance fees. That alone puts $144 or more back in your pocket every single year. Money that was quickly disappearing every month. You take every dollar of that and redirect it toward the next step. The next step is your credit score. And I want to be clear, fixing your credit is not some long mysterious process. The 2 biggest factors are your payment history and your credit utilization. Make every minimum payment one time. Get your balance below 30% of your credit limit. Those 2 things alone will start moving your score up. That's really it. And when that score starts climbing, something important happens. Your insurance premium comes down. Remember point 3. Your credit score is one of the biggest pricing factors for car insurance in most states. A better score means a lower monthly bill. More money freed up without earning a single extra dollar. That extra money goes toward a small emergency fund. Even $500 sitting in savings completely changes your relationship with unexpected expenses. Right now, every surprise bill pushes you into overdraft or onto a high-interest credit card, which triggers fees, which triggers more debt, which drags your score back down. A small emergency fund breaks that cycle. It's a buffer between you and everything that has been bleeding you. Each step removes one layer of the poor tax, and removing the layers frees up real dollars that fund the next step. You're not trying to fix everything at once. You're just trying to fix the first thing. This isn't about perfection. It's about momentum. One domino at a time. You don't need to fix everything. You just need to fix the first thing. And everything else gets cheaper from there. Now that you can see the poor tax for what it is, the next question is, what do the people who escape it actually do differently? And I broke that down in detail in my video, 9 tiny habits that separate rich from broke. Watch that next one, and I will see you there.